Broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning, good afternoon, wherever you are in the world. My name is Nick Katko, president of BMA, and today we are going to do a little webinar on the fundamentals of value stream costing. Before we get started with the webinar, there's a little bit of standard work we have to do to make sure that everything's working. First of all, I want to confirm that you can see me, you can see the presentation, and you can hear me. So if you would just respond, a few of you, yes, okay, that's great. I want to make sure that works. Okay, thanks, folks. So at the end of the webinar, if there's some time for questions, I will answer as many as I can. So please, as the webinar is going along, type in your questions in the question pane on your control panel, and then we'll get to them at the end. Also, it's important to understand that the handouts are available. Let me move my screen. If you go down to the handout section of your control panel, as indicated in the square box, you can download a copy of today's presentation. If by some chance you forget to do it or you need it later, please contact me via email. I'll be glad to send this again. So that's all the standard work. So let's get going with the presentation. I have 4 learning objectives that I'd really like for you to achieve today during the webinar. First is to be able to explain the difference between traditional cost paradigms and, I'm moving my control panel, there we go, traditional cost paradigms and lean thinking cost paradigms. Secondly, there are 4 primary direct value stream costs in all organizations, and I'd like you to be able to identify those 4 for your business. Third, understand what value stream costs are, what value stream shared costs are, and how you assign them to value streams. And fourth, be able to explain why lean financial coaching is necessary for value stream costing to be successful. A lean business strategy is all about alignment. We are trying to align the entire organization around one comprehensive strategy. This also includes financial information. And the idea behind value stream costing is to understand our costs at the value stream level. Value streams are the primary unit of organization, management, control, and improvement in a lean organization. So we want to align our costs as much as possible so we can develop good relationships between good cause and effect relationships between operations and financial information. So let's start with paradigms. Hold on one second. Paradigms. These are really thinking patterns. And when it comes to understanding costs, there are a lot of deeply rooted paradigms associated with understanding financial costs. Some of these are based on traditional financial practices. Some of this is based on industry or business practices. And another reason is the way our financial statements are set up. Much like lean, the key to success with a lean strategy is changing thinking patterns. So for value stream costing to be understood and be successful, we have to focus on changing thinking patterns. And I've learned from my own experience and also from working with many, many companies that if you can change the thinking patterns, the fundamentals of value stream costing are very simple and apparent. So let's talk about some of the common paradigms. First is labor, our labor costs. In traditional paradigms, labor is an expense that has to be managed. Head count matters, how much you're paying in salaries and wages. Now, yes, labor is an expense in the financial statements. That's the way it's been set up for many, many years within financial accounting. However, from a lean viewpoint, lean organizations consider their people to be their most important asset. And if you ever look up the definition of an asset, people really fit that in the fact that they deliver value and they have utility over an extended period of time. So from a lean viewpoint, we think of labor as an asset, the people as an asset. And what matters is the productivity of the workforce over time. In the book, The Lean CFO, I have a little section on this where I say headcount doesn't matter, productivity does. So the reason we want to understand productivity is it's a good cause and effect relationship as to why our labor costs are what they are. Low productivity means you probably have a higher labor cost than necessary. So focus on the productivity and you will control your labor costs. The second paradigm is time and costs. And this is a paradigm that is true in manufacturing, it's true in service businesses, is that the longer the processing time, the higher the costs. This is the idea that, well, in manufacturing, one product takes a lot longer to produce than another, so its costs must naturally be higher. Or it takes longer to process a complex tax return in an accounting firm, therefore the cost of that return is much, much higher. From a lean viewpoint, time is the second most important asset next to people. And so the new paradigm is time is also an asset, and we want to maximize the value-added time. If it takes long to produce a product or deliver a service because you have more complexity and more value-added time in there in that particular service or product, that's fine. However, if you have a lot of non-value-added work in the process and that's causing one product or one service to take longer than the other, that's not okay. So it's about understanding the activities and the process to understand why something takes as long as it does. When we look at analyzing costs, traditionally we create complex allocation systems to try to understand costs at a very granular level. And a lot of this is sort of like top-down thinking in the fact that, well, maybe accounting and finance, we get the costs and we're going to allocate the costs so that other parts of the organization understand how much it really costs to run their part of the business. The problem with complex allocation systems is they are very subjective. They are not always accurate. They take a lot of time to maintain. And there typically is so much variability, especially in a factory, that you have variability of production, variability of product mix. Maybe the same is true in services, is that the foundation for the allocation basis is really not accurate. So from a lean viewpoint, we want to look at the root cause of spending at the source of spending. This is sort of like applying lean problem solving to cost management. So what is driving the spending decision? I make an argument when I'm training and consulting is that 90% of spending decisions are the result of the way the way that the operation is running. So understand the operation, and you'll understand the root causes of spending, and it's much more accurate. Another paradigm are objectives of costs. Traditionally, it's about cutting costs. How do we cut costs 5% next year? And when we look at cutting costs, we're looking at absolute reduction. So we spent this much in 2018, we have to spend this much in 2019. And it's sort of like, well, make it happen. Again, this is a lot of top-down thinking, and it leads to the phrase I use is a lot of financial engineering, is that we have to make this happen. And so we dictate how many people an operation must have to keep the cost down, et cetera, et cetera. Lean looks at reducing costs over time through improvement. And Taiichi Ohno, one of the sort of the godfathers of Lean, he worked at Toyota a long time ago, and he had a lot of very good sayings. And one of the sayings he says is that costs are meant to be reduced, not managed. And if you ever read about Toyota, they focus on cost reduction over time. They want to be a low-cost producer. It's really about the method in which they go about it. They don't actually set up cost-cutting exercises. They focus on operations, and they focus on reducing cost over time. One simple example would be that the percentage of labor, total labor costs compared to sales, goes down over time. That is a cost reduction. And this is a long-term view, not short-term cost cutting. Managing of costs. From a traditional viewpoint, we have to meet the budget. I once worked at a factory in Tennessee, the neighboring state from which I live, and the plant manager had to excuse himself from a lean accounting event. He had a budget meeting on the phone with the corporate people. And this was about 7 months into the fiscal year. And he was really concerned about this budget meeting because he said, we set our budget up we set our budget up months ago based on a certain product mix and a certain volume. And since then, corporate made some decisions where they moved some products out of that factory. They moved some products from another factory in there. And so it totally changed the production rates and the production volume and the production mix. And basically, because of that, the budget was irrelevant. Yet, they still held them accountable to the original budget. And that's the problem with budgeting, is that these assumptions are very static and they're often outdated. So from a lean accounting viewpoint and a value stream costing viewpoint, we want to look at the dynamic relationships between performance, capacity, and costs. And these relationships change over time. Sometimes they change rather quickly, month to month, maybe week to week. And if we use value stream costing, we can establish these relationships and understand how they're working. If you use static numbers that are not real, you can't get that granularity of understanding. The final paradigm is profitability, is the idea of analyzing by customer, by segment, by business unit, by product, slicing and dicing profitability to try to understand what's driving it. Lean simplifies everything. Value streams are the profit centers of a lean business, so we want to look at profitability, revenue, and costs by value streams. And the more that we align our costs to value streams, the more we understand the impact of flow, the impact of waste, and the impact of improvement on the value stream and on the costs. We also have to sort of adjust our definitions of costs. So we have fixed and variable costs, and these terms have been around for a long time in finance. And so we want to really have standard definitions as we get into value stream costing. A variable cost is a cost that varies with volume in the short term. Pretty simple, right? A fixed cost does not vary with volume in the short term. It is also influenced by decisions, management decisions, business decisions. One simple example, hiring people. That is a management decision to hire people, okay? Or if you buy a machine. So that's what and your machine costs, your labor costs don't vary in the short term with volume. They vary primarily based on capacity issues and the decisions that you make. So in a lean organization, more costs are considered fixed than in traditional organizations. One of the reasons why traditional organizations think they have more variable costs than they do is because of existing cost allocation systems which may be present, or maybe the use of rates. Anytime you're using a rate, cost per blank, you're really trying to convert a fixed cost into a variable cost. One of the easiest examples is in manufacturing, and is direct labor. In traditional manufacturing organizations, direct labor isn't considered a variable cost. Why? Because that's the way it is in the cost management system, in the standard costing system. It's variable because it changes based on rates. But the reality is that labor is a fixed cost. So again, you want to understand in your organization how people think and mentally define fixed and variable costs. We also have to define value stream costs. So we have a value stream direct cost. So these are costs that are controlled by the value stream through operations and decisions. If you think about it from an accounting viewpoint, think about it this way, that a cost can easily be charged to one value stream in the general ledger. So if you're posting an expense, you can say, yes, this cost goes here to this value stream. It's factual, it's a natural decision. You don't have to think about it too much. We also have shared costs. Now these are, and this is true in every in lean organizations, that the resource or the consumption, the use, whatever you're spending money on, is shared by more than one value stream. So think about it this way, is that the value stream can possibly influence the cost, the total cost, that they don't have real direct control. That direct control is still operational, but it may reside in another part of the business, or some things may be beyond the control of the value stream. For example, a utility bill. You can't change your utility provider and they charge the rates they charge. So that's one thing. Maybe you can reduce the amount of consumption in some way, but that has to be done throughout the business, not just in one value stream. And then you have your typical business support costs. Sometimes they're called selling general administrative costs. These are the other organizational functional costs, mostly on the administrative side, and we don't assign or allocate these costs. So what we want to do is we want to introduce these definitions: direct costs, shared costs, support costs. We want to eliminate old definitions such as direct labor, indirect labor, overhead costs. So again, we have to weave this into the organization and train people on it. So wrapping up paradigms, think about your company. Which traditional paradigms are present? How entrenched are these paradigms, and at what levels are they in the organization? I mean, does the senior leadership team or the owners of the business have some of these paradigms that they use in terms of their financial cost thinking? Is this due to reports and analysis that are produced? Is this due to the way we discuss? Is this due to corporate structural issues, or is it sort of cultural? So it's really important to assess this as you introduce value stream costing, because it's really about changing thinking. And we want to use real numbers. We want to practice new thinking patterns often to change thinking. And so that's how paradigms get changed. So now let's move on, and we'll talk more about the actual details of value stream costs. There are 4 primary types of value stream costs. We have labor, materials, machine or equipment costs, and labor, materials, and then machine or equipment costs typically comprise most of the overwhelming majority of value stream direct costs. When I talk about materials in manufacturing, that's obvious. We're talking about the raw materials and components used to produce a product. Service businesses, non-manufacturing businesses may also have materials. For example, if you think about healthcare, the supplies may be a significant expense. And then you have machines or equipment. I use both terms there because machines, people think in terms of manufacturing, but you might have equipment costs. In healthcare, you have a lot of equipment that's present in a value stream. In service businesses, if you're heavy in terms of technology use, it might be your IT equipment. So again, these costs are real in both manufacturing and non-manufacturing. And then there's always the catch-all that accountants like is other. So let's talk about these costs in detail. Now remember, the goal in this process is to identify as many direct costs as possible. The reality is that the perfect value stream doesn't exist. So this is a process. And you want to go through the process and do as well as you can. Don't let this hold you up. Try not to be perfect. Just try to be good at it and practice it, and you'll get better. Labor. So how do you identify your direct labor? If you have a value stream structure and value stream organization, people are assigned to value streams. Not every person in every company is in a value stream, but when you look at it from an operational viewpoint, you typically assign most of the people who are performing the value-added work to a value stream, or maybe they are machine operators, and then you have supervisors and managers and maybe some support people. So you have a value stream map, you have a value stream structure, and that tells you who works where. How do you assign the cost? Do it through your payroll system. Payroll systems have the ability to charge people to a department or a cost center. Well, you just add in the value streams and you assign those employees to their value streams, and then their costs get automatically assigned through the general ledger to those particular value streams. Here's a consideration to keep in mind. Full-time equivalent employees can be used rather than specific employees, but you want to use whole numbers. You don't want to say 1.25 people or 2.67 people are in this value stream. You can say in general, we have 5 full-time equivalent employees in the value stream. You can assign salaries. So again, I give you that consideration just in case assigning specific people might be a little too difficult in your organization. Just don't use fractional employees if you're using full-time equivalent. When we look at material cost, we want to understand the actual cost of material that is consumed by the value stream. So what we need to determine is at which process step can material be specifically charged into a value stream. This is probably more relevant in manufacturing than non-manufacturing. What I mean by that is sometimes maybe you bring in some common raw materials such as rolls of steel, and there's some initial production operations in which those rolls of steel are cut and fabricated into many, many components, which then are used in various value streams to produce different types of products. So you have, when you can't assign the roll of steel to one particular value stream because it's going to be used many, many places. So what makes the most sense? That's what you have to think. Is it at the point of purchase or at the point of issuance? If a material comes in and if a purchase comes in and that material goes into one value stream, that's how you charge it. If you have common materials that come in, do it at issuance. We're trying to drive root cause analysis with material. And the reason we use consumed is because there's 3 outcomes of material consumed. You can use the material to produce your products or maybe deliver services and sell. You can stock your material or you can scrap it. Now, from a lean viewpoint, we want to produce and sell more. That's the good outcome. We want to reduce scrap. We want to reduce the amount of inventory we have in value streams. And so using the actual cost will allow us to develop very strong relationships between quality measures and material cost and inventory measures such as days of inventory or inventory turns and material cost numbers. Machine costs. We typically have depreciation, which can be identified by machine. We have repairs and maintenance, which sometimes can be assigned specifically to a machine. We have tooling expenses, and then we have possibly utilities. I put the little asterisks there because from a utility or energy cost viewpoint, it really depends on if you know specifically how much utilities a machine is consuming. That would typically come in by having meters on the machines, and then you can assign specific costs based on usage. So just remember that definition, the accounting definition of a direct cost. It's a cost that can be easily charged to one value stream. So in this case, how many costs can be easily charged to one machine? Those are your direct costs. And then you have your other costs. And again, I go back to that definition. Any cost which naturally can be charged directly to one value stream in the general ledger. Charge it as a direct cost. What you want to avoid, especially in accounting, is creating some kind of allocation system to try to be very, very precise. We want to avoid that. And third, lastly, consider the materiality of the expense. If something is a very small percentage of the total direct costs of a value stream, is it really worth trying to spend a whole lot of time trying to figure it out? If you get labor, you get machines, you get material, you're going to be in really, really good shape. Don't overthink this. That's one reason why the word naturally is in red, bold, and italics, is because it's what makes sense. If you look in accounting, you see an invoice, yeah, I can charge that. That's sort of your acid test. Here's another example. Here's a good method on the left. Many factories have vending machines for small consumable supplies. And so what happens? You go up there, you type in your employee code, you pull out a pair of gloves or whatever you may need, and then it's very easy to see based on the employees who's consuming what supplies, and then from there you can charge your supplies to specific value streams. A poor method is on the right, creating different kinds of rates in order to try to assign these other direct costs. So use a lot of common sense, keep it simple, and you'll get what you need. So that wraps up the direct costs. Now let's talk a little bit about shared costs. What are the characteristics of shared value streams? One is that the value stream can influence, value streams can influence the shared costs through operational practices and decisions. However, the actual control of the cost, the spending decision, and the management of the cost typically is done outside of the value streams. And third, it's important to understand that some shared costs over time can become direct costs as lean operations mature. So I've seen companies really get into get confused by this or get really tangled up in trying to figure this out. So my general advice is what makes sense today? Based on your value stream structure, and if you do direct costing first, then it's easier to deal with the shared costs that are operational in nature. So let's look at some examples, because there's three primary categories of shared costs, which I wanted, and once you understand that, then you'll see what I mean. First is our facility and warehouse costs. This is the rent, the interest if you have a loan, possibly utilities, repairs, maintenance, depreciation on the facility and the warehouse, or if you're in non-manufacturing, your building. Then there are production monuments. What is a production monument? A monument, the term monument is a lean term if you're not familiar with it. It's just a value-added process step that is shared by more than one value stream. And most manufacturing organizations have a monument or two in their business. And what are the costs involved? Well, you have materials, you have labor, you have machine, equipment costs, and maybe other. The third type is operational support. So these are your typical or traditional operational support functions that they don't have direct involvement in producing the product or maybe delivering a service, but they support operations. So we have purchasing, planning, engineering, quality, receiving, material management. Most of these expenses are primarily labor, but you can also have some other costs. So the real question is, how do we create a simple system to assign these costs? That's really what we want to do. And we want to do it because we want to understand value stream profitability. So let's look at how we can do this. We want to assign costs to understand value stream profitability. You want to use the simplest method possible based on if you can identify how the value stream influences the cost. This may or may not be possible depending on what cost you're talking about. I'll give you some examples in a minute. And here are some considerations. What is the frequency of the analysis? So the method of assigning costs, if you want to use the word allocation, that's fine. But the method of assigning a cost, a shared cost, should match up to the frequency of the analysis. Be careful about labor costs. They're tricky, and you can simply fall back into traditional habits of trying to be exact about how much time an operational support department spends in value streams, and you can get into things like, well, we need to track time, which is not something we want to do. And again, that's all allocations. So again, keep this simple. So here are some tips. Facility and warehouse costs. Assign these costs based on the value stream, square feet, square meters. Less space is needed over time because of lean. As you deploy lean practices, you should shrink your space, and therefore the assigned cost goes down. I was one time in a factory doing some lean accounting consulting where half the factory was empty because they had created flow, they needed less space, and so they had half the factory empty, which was reserved for future growth. Production monuments, you assign based on production. What percentage of parts produced by the monument go into each value stream and assign the cost that way. And then you have operational support. Again, go back to the definition that when we talked about direct costs. Can you assign operational support people based on full-time equivalent employees? Again, whole numbers only, not fractional. If it's too difficult, then don't assign the cost. Leave it as a support cost and don't assign it. You can do facilities, you can do monuments. The operational support, I've seen that because it's related to people and activities, that's where in the early stages of lean, it might be difficult to do. Don't let that hold you up from doing value stream costing. The good news is that shared operational support measures change over time, can change over time. In the early stage of lean, you have a departmental structure. So you have the shared costs, which you can assign to value streams in some simple way. Over time, primarily due to continuous improvement, the support work can move into the value streams. You may, for example, begin to assign quality people to one value stream, engineering people to one value stream, or you may assign the work. That's the idea of quality at the source, where the people who are building the product, they do their own inspection, so you're moving the quality. A Kanban system to suppliers, where the value stream is actually sending the Kanban signal directly to the supplier, so you're moving purchasing work into the value stream. And you can do this because you have created capacity. So over time, you may have more value stream costs and less shared costs. And then when you become a mature lean company and get closer to a true value stream organization, you'll probably have some minimal shared costs and assignments. But I like to say it's unlikely that all the shared costs go away, but they mature over time. And that's why I go back to don't try to predict what the future is going to look like. Do what makes sense today in terms of shared costs. Create a simple assignment method. And then as lean matures and you see the physical changes in how these support departments are structured, you can change the costs accordingly. So wrapping up, value stream costing. What you want to do is understand the obstacles. What is prevented? What is it out there that could prevent you from doing value stream costing? Is it paradigms, thinking paradigms? Is it systems? Is it internal reporting? Understand that. And understand the root cause of the obstacle. This is sort of like lean problem solving. And then create a plan to remove each obstacle. If you're going to do value stream costing, if you are going to create a value stream income statement, you really have to remove other costing analysis methods. So value stream costing is not adding another layer to everything else you're doing. It's about putting value stream costing in and taking other traditional type methods of analyzing costs out of the business. And so that's really the challenge that you face. Now, how do you deal with that? That's where coaching comes in. So the idea behind lean financial coaching is that you're trying to change thinking, whether it's one person, a group of people, or the organization. And changing thinking requires very interactive and personal type coaching. It's people don't just change their mind all of a sudden. You know, some people do. Some people might go, that makes total sense. Okay, I'm in. Other people don't. They don't because they don't understand. And so there needs to be leadership through financial coaching. Think about this example. If you're in a factory and you change a production line, change the layout of the production line, the people that work on that line now have specific tasks. And they might be a little different than the old production line. But they can't go back to the old way because you've redesigned the line. So it's very physical, it's visible. When it comes to financial numbers, it's really all about how we think. It's our beliefs, it's our assumptions, it's past practices. And so this takes time to change. So the way you make it happen is through coaching. So you want to shift the mindset of how people think away from traditional type practices like cost cutting or thinking about cost cutting to financial cost management, lean financial cost management, value stream costing. You want to establish new thinking patterns. What you want to reveal are competing assumptions and traditional practices. And the only way you understand this is through human interaction. It's a conversation. And you're trying to create the right habits. You create the right habits by doing something frequently and having short, nurturing feedback loops. So the reason you want a short feedback loop is because if you see that a competing assumption is winning out in terms of understanding value stream costing, you need to correct that. So this is a very active process. The way you do coaching is by having some guiding principles. And you use the guiding principles to drive the everyday learning. So what are the lean financial cost management principles necessary for value stream costing to be successful? So on the left side, you see the 5 principles of lean. And on the right side, you're going to see the corresponding cost management principle. So the first principle of lean is customer value. So what we want to deliver inside the organization is actionable cost information. Cost information that can be used to take true action inside the business to influence and change that cost. Second principle of lean is value streams. So we want to look at direct value stream costs. We establish a very strong cause and effect relationship between value streams and costs. The third principle is flow and pull. So we want to be able to do root cause analysis. Having direct costs in place makes it very easy to sort of pull in true root cause analysis and establish these relationships between operations and our costs. The principle of continuous improvement, the cost management principle is that continuous improvement will reduce costs over time. So again, focus on establishing strong continuous improvement practices that drive operational improvement, and you will see costs go down over time. And finally, empowering employees. Value stream costing is part of a financial learning system. We are trying to develop a level of financial competency at every level in the organization so that people have a very intuitive sense of how they can influence costs in the business. And this is a learning system. And value stream costing is an essential first step in this. These are the principles. Now what we want to do is establish practice routines to reinforce those principles. So the first practice routine is understanding how lean works. And this is sort of ingrained in lean practices, but it has to be also explained from a financial viewpoint. Lean organizations eliminate waste, they create capacity. You use that capacity to create a competitive advantage to sell more products or services and drive revenue growth. So this thinking has to become routine in analyzing costs and decisions. Traditional cost management practices typically mask this aspect of lean. And that's why it's very difficult to use traditional cost management practices in a lean organization. The other practice routine is the weekly box score analysis done at a value stream level. Box score has 3 components. One is the performance measurements for the value stream, and improving the value stream performance will eventually have it will have an impact on value stream costs. Sometimes it may be a direct cost savings, but others over time you may see a reduction. We're looking for the dynamic relationships between value stream performance, capacity, and the financial impact. And as I mentioned in the previous slide, we want to see that we are eliminating waste, creating more capacity, which shows up as the available time percentage, and then are we employing that available capacity in value-added methods to drive revenue growth. So looking at a box score on a weekly basis, we develop this routine, this thinking habit, and we begin to learn about these relationships. and we establish valid relationships that are factual in nature. Another practice routine is in understanding the financial impact of business decisions. So in this case, we have a value stream which has made some improvement in performance, as you can see from the improvement in on-time delivery, first time through and in dock-to-dock days, but there's not much change in cost or profitability. But we've created a lot of capacity. So that's what Lean does. Then the financial analysis piece is to look at the various alternatives of using that capacity. If we have actual direct value stream costs, then we see exactly how much money we'll be making. And we see the real financial impacts. So this is another practice routine that we use to reinforce value stream costing. So to wrap things up here, what is required is the leadership of the accounting and finance people to be lean financial coaches to make value stream costing work in your organization. What do you have to do? You have to communicate. You have to establish the vision for value stream costing as it relates to your overall lean strategy, explain why it's important, and other people in the organization must understand it. It's not good enough for you to just understand it. So it has to be explained in a very, I want to say, non-financial way. That's the best way to do that. Leadership. Lead by example. You have to believe in value stream costing. You have to be good at it so that you could become a coach, or a mentor on a regular basis. Creating a good value stream costing system is not simply having one meeting and saying, here's what we're going to do, or sending out an email. It's about a conversation. It's about interaction with the non-financial people in your organization, and also inside the accounting group. Focus on developing your people in terms of their thinking. So this is your active coaching, where you're practicing, you're solving problems and obstacles, whether it's in a weekly value stream meeting, whether it's analyzing a business decision, whether it's presenting to senior leaders, and also celebrate the effort and celebrate what you learn. So that wraps up the formal part of the presentation. Before I get to questions, I wanted to give you this link, and it's in your presentation. So if you download it, you can click on this. This is a link to all of the webinars that we at BMA have done in 2018. And there is 5, 7, 8, 9. There'll be 10 webinars that we've done throughout the year. They're available, they're recorded, they're free. You're welcome to listen to them. You're welcome to share the link with anyone. And today's webinar will also be there. Okay, so if you want to learn more about BMA, please visit our website for blogs, articles, and books. Here's my email address. Please email me if you have any questions. And then we have the LinkedIn BMA Lean Accounting Group, which you can join and use as a forum to talk to other people who are interested in lean accounting. So what I'm going to do is get to the control panel and take a look and see if we have some questions. So the first question is from Roberto Forte, and the question is, on average, what is the percentage of assigned cost to value streams as compared to overall costs? He says he guessed many costs are shared. When you're looking at your value stream labor, your value stream material, your value stream machine costs, as a percentage of total costs in your business, it may not be that high, primarily because you have administrative costs like accounting, HR, senior leadership, sales and marketing, product development. I don't think there's really a benchmark. Now, if you look at operational costs, it's probably a high percentage. I would say 80 to 90% of your costs can probably be direct. And really, let's see, here's another question from Urban. And the question is, how can we determine the cost and benefits of undertaking process improvements? Any books or articles that you can recommend? Great question. Go to our website. Any of our BMA books will help you understand this. It's really about when you make an improvement, most improvements create time. There might be some direct cost savings, which again, if you have direct value stream costing, you can identify those specific costs. And the actual benefit is, what do you do with that time? So take a look at the website. And if you have any more questions, Urban, please contact me and we can talk more about this. Any recommendation? Francis has two questions. One is, any recommendation on textbooks in line with your mindset, paradigms, and vision? Let me think about that. Don't really have any thoughts right off the top of my head, but if I do, I'll follow up with you, Francis. And any examples applicable to NGOs, which are non-government organizations? I don't have any specific examples. I've worked with nonprofits, but not non-government organizations. But it's still the same practices apply in terms of, what are the value streams in the NGO, and how do you assign the costs? I would say that you're probably really going to have costs of people, and probably depending on what the NGO does, you might have some supplies and materials. And again, Francis, since you have a special niche here in terms of the type of business, I'll be glad to talk to you further about this if you want. So that wraps up all the questions. Oh, one more. Francis has one more. Any tips on how to get the best of your teachings to Industry 4.0? I don't know how. Why don't you write me an email about that one? We could have a further conversation. I know a little bit about Industry 4.0, but I've never really spent time thinking about how value stream costing integrates with it. So I'd like to thank you for your time and look forward to more announcements for webinars in 2019. I should get a schedule together in early January. The goal is probably to do at least one a month, and I'm going to try to do them on different topics. And and if you have any topics which interest you, please send me an email. I can always use customer recommendations as to what to do topics on. So thank you for attending the webinar. You have any questions about this, please contact me. You'll get follow-up messages tomorrow with a link to the recording. And I hope you all have a happy holiday season. Bye-bye.